This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachurides. Thanks for joining us at XM.com. The relentless rally in the US dollar is gathering momentum as market participants seek refuge from the troubles in other major currencies and brace for a more forceful tone from the Federal Reserve trying to wrestle back control of financial conditions. A deepening energy shortage has torched the euro, with natural gas prices in Europe hitting record high after record high, turning entire industries that used to rely on cheap energy unprofitable or uncompetitive. Meanwhile, the Bank of Japan has left the yen for dead with its refusal to even consider tighter monetary policy. The British pound continues to trade like a mirror reflection of unstable equity markets, and the meltdown in China's property sector has ravaged the commodity currencies. Speculation that the Fed will strike a more assertive tone at the Jackson Hole's Economic Symposium later this week has probably added fuel to the dollar's rally. Despite raising rates with incredible force and signaling that more is in the pipeline, U.S. financial conditions have loosened lately, which is counterproductive for a Fed still trying to slow the economy and tame inflation. A seismic shift is underway in China. The crisis in the beleaguered property sector is spiraling and threatening to infect the nation's enormous banking system. To prevent contagion and shore up confidence, Chinese authorities announced last week they will be offering special loans to troubled property developers, while the central bank cut its lending rates by 5 to 15 basis points today, focusing its firepower on longer-dated lending rates. The news provided some relief to the Australian and New Zealand dollars. That said, it seems the People's Bank of China is bringing a knife to a gunfight, as the rate cuts are too small to make a real difference and might simply counteract the impact of rising rates abroad. The euphoria that characterized equity markets over the last couple of months is evaporating. Wall Street lost around 1.3% on Friday, and futures suggest the selling will resume today as market participants trim some risk exposure ahead of the Jackson Hole Symposium and after a stunning run overall. The S&P 500 got rejected exactly at its 200-day average, and the catalyst for the reversal was the same that enabled the relief rally in the first place, the bond market. Gold suffered for similar reasons. Real and nominal treasury yields are grinding higher, while the greenback bulldozes its way through the FX arena, which is a toxic combination for gold that competes with bonds for capital flows and is generally priced in US dollars. This is today's Daily Market Comment. Thanks for joining us at XM.com.